Everyone, welcome to today's episode of Chart This with Dave Keller. It's Thursday, October 31st. Happy Halloween, and welcome to our show. I'm your host, Dave Keller, coming to you from a kind of chilly but still beautiful Redmond, Washington. Thanks for joining me every weekday after the close as we break down the market action using technical analysis. We're kicking off a little later than normal here, just before 4:30 p.m. Eastern. Had an opportunity to meet Tom McClellan, legendary technical analyst who's based in the Seattle area. Not a close commute from where I'm at. We're kind of in different parts of the region, but worth getting together with him, and great to see him after too long of not doing so. We had a lot of really interesting discussions about the markets and about technical analysis, about the McClellan oscillator and other techniques we are both certainly watching very, very closely. He did agree to come on the Market Misbehavior podcast very soon, so I look forward to scheduling that, recording some great content for all of you. But thought it was worth being a little delayed to make sure I could reconnect with Tom. So shout out to Tom and the followers of the McClellan Market Report, which has been continuously published for many, many moons. While I'm there catching up with Tom, the market's deteriorating big time. Obviously, quite the fallout this week after SMCI disappointing after the negative news from AMD. Now we're seeing that start to have a viral and negative connotation for leading names Microsoft and Meta, and along with many others. The growth space certainly feeling the pain today with the NASDAQ down almost 3%. Is that enough to really confirm sort of a new bearish environment? I don't think so, right? Technology down quite a bit today. The XLK was your worst performer, down over 3%. A lot of leading names, though, still holding up, right? So, I mean, it's sort of a painful move. I would not be surprised if this is sort of an impulse move in a new corrective trend to the downside, meaning I would not be surprised if this is the beginning of further deterioration. I'm just saying my analysis of the charts tells me the trend isn't reversed just yet. All the warning signs have been flashing, as we've covered hopefully very closely for you in terms of breadth deterioration, momentum divergences, all those sorts of things. Let's look at the charts and see how today's sort of deterioration in price action fits into the relative trend that we've been talking about so far. Getting to our market recap here, we can see that the S&P 500 down almost 2%. We'll call it 1.9%. Closing just above that 5,700 level. Even at the end of the day, it looked like there might be a little bit of a positive reaction, but no. Last 10 minutes, just sort of a sword into the gut of the markets, as it were, just continuing to go lower. The Nasdaq Composite, obviously, even worse, down 2.8%, finishing just below 18,100. The Dow was down slightly, just under 1%. Outperforming those other two, but still in the red. S&P small cap and mid caps down as well. The mid cap S&P 400, your best performer, and that was still down 1.3%. The VIX, well above that 20, that back of the envelope level that we've talked about for quite some time, right? 20, sort of that general way of dividing a strong market or a volatile market, high volatility market from a low volatility market, and today, sort of confirming what we observed yesterday and through the course of this week. Elevated volatility. Elevated volatility usually means elevated uncertainty, elevated anxiety, and most of those things mean not elevated stock prices. They mean stocks are probably on their way back lower. Looking at the fixed income markets, a bit of a mixed bag of results overall. The 10-year yield and 5-year yield were slightly higher. The long bond yield was essentially flat for the day, down a little bit from yesterday's close. Bond prices up a slight amount, about 0.25% for the TLT. Dollar, no real change. So the action was really in the equity space, not as much in the bond markets, where interest rates essentially remained relatively stable. A lot of commodity movements, though. We can see crude oil prices actually moved higher. Energy ended up being one of the better performing sectors today. Gold and silver prices both down. And that's an interesting one because, a lot of people tend to think of gold, silver as sort of a safe haven. But for one day, at least for today, pretty highly correlated to equities, right? And I think the maybe the difference is gold has been so strong, even while equities have been strong as well, right? Both of them have been in primary uptrends for most of 2024. In reality, gold has outperformed both the S&P and the Nasdaq year to date, still with today's drop. But the GLD down about 1.6%. Silver, using the SLV, down about 3.25%. As I mentioned, crude oil prices actually in the green. A lot of red in crypto land, and this is it's one of those tough realities that Bitcoin's sort of threatening new all-time highs, setting up for this big move higher. Then all of a sudden you get this huge risk-off move in the equity space, and I think the challenge for cryptos here I think the biggest risk for cryptocurrencies is a deterioration in equity prices. Hear me out. Investors tend to not just be crypto investors. I mean, a lot of people have cryptos along with other things, right? You still own stocks or bonds or some combination of something in different accounts. And so if you're nervous about equities, if you're nervous about your portfolio, you're probably taking risk on overall excuse me, you're probably taking risk off elsewhere in your portfolio. And if you had cryptocurrency exposure, that's certainly one of the more risky and certainly more volatile areas of the market. So not super surprised to see things that have registered strong gains, certainly recently, all kind of coming back as equities sell off. So Bitcoin down about 3%, Ether prices down around 5%. We can see crypto, Bitcoin, that is just slightly above that 70,000 level. Big round numbers tend to be pretty meaningful. So I would certainly be watching that to see if we're able to maybe find a foothold there. Looking at the 11 S&P sectors, you can see pretty much a risk-off configuration here. 9 of the 11 S&P sectors finishing in the red. On the downside, we'll start there because this was a pretty big down day for tech. The XLK, the worst performer, down 3.2%. Let's remember that the XLK is dominated by big technology names like Apple, like Microsoft, like NVIDIA. So if those are coming off, the XLK, which is very top-heavy, is going to get weighed pretty down. Now, to be granted with you, it's not like the rest of the technology sector was particularly strong today as well. Look at the MarketCarpet in a short while. We'll see how overall is sort of a distribution day all around. REITs, number 2 from the bottom, down 1.7%. Consumer discretionary, the XLY, down 1.5%. Only 2 of the 11 S&P sectors in the green. Interesting to see utilities at the top, kind of a defensive play, but in 2024 has been more of a growth engine, right? I mean, it's been more about the extreme energy needs of AI and cryptocurrency mining and all of those things that seem to require a ton of energy to grow. Utilities are sort of in the middle of that need for more power. And so the utility sector up 1%. By the way, did drop the latest episode of the Market Misbehavior podcast last night. I caught up with Ari Wald of Oppenheimer. I've known Ari for a number of years. It's been really cool to see him grow into one of the top analysts on Wall Street. He's just a really nice guy, but also an incredibly talented analyst and thoughtful strategist and a very what I would call a market historian, a very knowledgeable market historian. His toolkit is all about looking at where we're at and thinking about how that relates to previous market cycles. So if you haven't listened to that, make sure you do so. That's on my YouTube channel, hopefully very soon on the popular podcast programs as platforms as well. But my conversation with Ari, we talked particularly about utilities, along with a couple other ideas that he saw as having some good potential going into the beginning of next year. Energy, number 2, crude oil prices going higher. So the energy sector hanging in there well. Also up 0.6%. Consumer staples slightly lower, about 0.2%, but still good enough to be in the top 3. We're going to go through the course of the day here or the show and talk a little bit about breadth conditions. I'll show you some of the warning signs that we've been discussing. As you can see from the little advancers decliners widget on stock charts, kind of a down versus up day in a pretty big way, particularly if you go to mid caps and small caps. Over an 80% down day, meaning 85% of stocks closing lower, only 14% in the mid-cap index closing higher. For large caps, still pretty negative. Looking at the mega cap growth stocks that we see here, Netflix actually in the green. And on a day like today where it feels like everything is down, and indeed most stocks are down, I think it's always helpful to look at which stocks are fighting that trend and are actually showing strength at a time of broad market weakness. Worth noting, Netflix is actually in the green here. Apple, number 2, this is another earnings name here this week, down 1.8%. Alphabet, down 1.9%. On the downside, you have Microsoft, down 6%. That's after earnings yesterday. Meta, down 4.1%. NVIDIA, down 4.7%. Now, what's interesting about this is, as we've talked about on the show, I mean, the risk to this market as we've gone higher has been, warning signs, right? Signs of distribution. And the signs of distribution we've seen up until this week generally speaking, have been not in these kind of names. It's been in other things, right? It's been in industrials or materials or energy, certainly, which has been kind of a rough place. But it's not been in the mega cap growth names. It's been other areas of the market. And these, largely speaking, have held up pretty well. And one of the things that we've been talking about recently is the danger, right? The risk of these mega cap names struggling. Because if that's happening, then everything's going to be coming down because the indexes, right? The market as defined by the S&P and the NASDAQ is essentially a reflection of these particular stocks because they dominate most of the cap-weighted indexes that you would follow here in 2024. So if Microsoft, Meta, and NVIDIA are all down 4 to 6%, I can't imagine that's a bullish day for stocks, generally speaking. That's got to be a pretty painful day, and you're certainly seeing that play out here. As a reminder, as we get to the market carpet visualization, I can see questions that you're putting in. I do see some chatter from some of the different places where we're posting this live stream. We're on Facebook, on LinkedIn, on YouTube, and on X. So we appreciate you so much tuning in from wherever you're at. As a reminder, I can't see those questions, so pop questions in at the end of the show. Time permitting, we'll grab a question or two. Anything we don't get to, we'll throw it into the chart. This mailbag. We're doing an all mailbag episode tomorrow on Friday. We'd love to answer one of your questions on the air. All right, getting to the market carpet. I mean, my initial takeaway, obviously, is just the bright red in the biggest boxes. This is what a big down day led by mega cap growth is going to look like. Again, you can't overstate the strength or the impact that those leading names have on our benchmarks. Our benchmarks are market cap weighted, generally speaking. Although, again, some of my conversations with recent guests, with Mark Newton weeks ago, we talked about equal weighted indexes. Just yesterday with Ari Wald, we talked about cap weighted versus equal weighted indexes and the different messages we're getting in recent days relative to those comparisons. Today is one of those days where the fact that the S&P 500 and NASDAQ 100 are calculated on a market cap weighted basis, which means those biggest names have a huge impact on the major averages. So even though the S&P was down a ton today, it certainly felt like that. The NASDAQ was down big time. It's really those mega cap names, right? For a moment, block out the technology sector, literally cover it up on your screen, cover up communication services, cover up Amazon and Tesla. The rest of the heat map isn't horrible. I wouldn't say it's great, like real estate down about a lot of materials names, a lot of random names down. But, the impression that you get where it feels like there's a lot of red on the screen, it really is localized to some of those larger names and especially technology. And that's been the big, I think, change in the message the markets are providing to us this week versus previous weeks. When the market's going higher and growth stocks are working and technology's leading, everything kind of feels great. But the moment you see days like this, weeks like this, where there's distribution, where you see profit taking, where you see aggressive moves to the downside, and you think about just the amount of a market cap that's represented in those names going lower, that hurts, right? And that's going to be the type of thing that really starts to hurt returns. The more that you see days like this. Elsewhere, I would say, though, remember one of the great exercises I think you can do on a day like today. All right, the market's down, a lot of stocks are down. That's fair. Look at the areas of strength, right? Look for things that are up, and we don't have time to go through all of these, but in communication services, I'm looking at AT&T, Comcast. These are both up 2 to 4% today. Paramount, right? Some of the entertainment names. Warner Brothers, Discovery. These are not particularly great charts necessarily. WBD has been sideways at best for the last 6 months, but there are areas of the market. AT&T comes to mind as a higher yielding, primary uptrend, strong momentum name here, but also paying a pretty strong dividend. So there are opportunities with the consumer discretionary, which is obviously dominated by Amazon and Tesla, both down quite a bit. You have Booking Holdings up almost 5%, making a new all-time high today. You have, Etsy's not a great example. That's bouncing off a low. NCLH, there we go, making a new 52-week high. Cruise lines continuing to cruise higher. Pun very much intended. Willis Towers Watson in the financial sector. So there are areas of the market that are still working. There are stocks that are breaking out. There are stocks that are in more constructive patterns. It takes a little more work in a time like this when there's a lot of red. Also, as a reminder, focus on sectors that are hanging in there. Consumer staples, not a bad day. Utilities, not a bad day. energy, right? And I still think energy still has much to prove. We have ConocoPhillips, Exxon, Chevron, all sort of in the earnings reports today going into tomorrow. So energy becomes a new focus tomorrow. But for now, let's continue on looking at these charts. All right. Continuing with our chart review, let's start with the S&P 500. So bad news, friends, is that the trend line that we've been talking about for quite some time has finally been broken, right? And so that's the reality of what can happen when you draw a trend line like this, is it works until it doesn't, right? And as we've talked about many times, that trend line is an accurate representation, I think, a visual representation of the pace of the advance. What you have to remember is when you're using a log scale chart, which I would strongly recommend you do on whatever platform you're on as much as you can, because that is a much more effective way of looking at trends over time, is by doing it on a percentage basis, or what we call a semi-log scale. It's just a more accurate way of representing changes in a data series over time. When you draw a trend line with a consistent slope on a log scale chart, that represents a consistent percentage return, right? So that line might represent 0.5% a month or whatever it is. And the number isn't necessarily important. What's important is that it's a consistent pace, because what that means is the more that line is tested, the more that it validates this stock is moving with kind of a consistent percentage gain over a period of time. And then when a day like today happens, where you clearly violate that trend line to the downside, it tells you something's different. And that's why this sort of day feels very much like an impulse move. And if you think about two types of moves, an impulse move, meaning a move in the direction of the trend, and a corrective move, a move away from the primary trend, this feels more like an impulse move to the downside. It feels more like the beginning of something and not the end of something. As a matter of fact, it's still too early, but we might go back and label this a breakaway gap, right? Sort of that initial gap lower that leads to further downside. Now, how do you tell if this is the beginning of something more? Well, we can try to predict it, but I've not found that to be especially helpful. What I do is I define a line in the sand, as we've talked about. This is why we did this a while ago, right? We talked about 5650 as sort of that level. And for me, 5650 and a break below that support level would mean a break below the 50-day moving average, to which we traded to the penny today. It would also be the breakout range, that breakout level from July and August now becomes potential support. And we're also today getting right down to the range of this early October swing low. So we go a little bit further. We go about 50, 60 points lower tomorrow into early next week. And I would argue that really would validate a new downtrend phase. And then we have to start talking about further deterioration. For now, we've gapped lower. We're holding the 50-day moving average. The momentum is weaker, but the RSI is holding 40. So it still could technically be considered a pullback within an uptrend. Breaking those lines in the sand is where you start thinking this is something worse. But I would say we're at that point. We need to be actively monitoring those levels. This chart really highlights three of the key things that I'm watching here in October, end of October of 2024, looking at the deterioration in breadth. That top panel is the S&P 500 on a closing basis. Next, we have the percent of stocks above their 50-day moving average. End of September, this is around 82 to 85%. Now at the end of October, it's below 50%. So about 30, 35% of the S&P 500 members were above their 50-day moving average a month ago and are no longer above their 50-day moving average. So that's why when some of these, larger names feel like they're just, starting to rotate lower, remember, a lot of other things have already been in breakdown mode for the last 4 weeks, right? Since the end of September. That bearish divergence in the percent of stocks above their 50-day, the bearish divergence we saw in the bullish percent index, all sort of now playing out. And this is the risk when we see those divergences, or periods like this start to emerge, and it's a warning sign of further deterioration to come. That bullish percent index, by the way, earlier this week broke below the 70% line. That's a cutoff for me, telling me we were in a very strong uptrend phase. And when we get below 70%, that's a big warning sign. That signaled Tuesday of this week. So again, I'm not surprised by what I'm seeing in the markets today. This feels like a natural follow through. These are some of the risk scenarios we talked about as very likely given the deterioration we've observed. On the bottom, I'm plotting the VIX, but I'm plotting it upside down in case you're wondering what that series is. And I did that just because a lower VIX tends to coincide with lower stock prices, and a rise in the VIX, a higher VIX plotted upside down is usually what lines up with falling stock prices. And the VIX going in and going lower usually aligns with rising stock prices. So by inverting the scale of the VIX, you can track it more closely with the movements in the S&P 500. So VIX back above 20 today. We finished just above 23. This is a new high for the last couple months. We're now getting back to the ranges we were in early August, which was pretty significant pullback from mid-July to the first week in August. So I would say breadth conditions, volatility conditions, very much in line with a concerning period. All right. To finish off the chart review, and then I'll look and take a couple questions. So if you do have questions that have come up, again, this is one of those days where I feel like there's plenty of things to talk about. So anything that's on your mind that you'd like to focus on, please drop it in the comments section of whatever platform you're on, and I'll do my best to answer one or two before we wrap here. ConocoPhillips reporting earnings today, gapping higher over 6%. Crude oil prices moving a bit to the upside, while the rest of the commodity space a lot more mixed and certainly negative in some areas. ConocoPhillips bouncing higher. And what's interesting about that from a technical perspective is COP has actually been kind of range bound here, right? Sort of a sideways pattern, what we call a consolidation pattern or a basing pattern. You can see support right around 102 to 103. We hit that in August, in September, again in September, now in October. On the upside, you have resistance around 116, 115 to 117, we'll call it the July peak, and really the late June peak, July peak, August peak, October peaks, the 200-day moving average right around there. So the gap higher just keeps this range going. And so I would say this is one of those times from a technical perspective, you kind of got to go with the Jesse Livermore quote, time to go long, time to go short, time to go fishing. This is one of those time to go fishing times because you're waiting for a resolution. You're waiting for a break above resistance or below support and some sort of follow through. The RSI has kind of been neutral, right? It's kind of covering around that 50 level. So looking to see if and when it could break. Maybe we see continued bullish sentiment out of the energy space tomorrow when we start to see these names recover. But I still think early days from a technical perspective there. I did want to highlight Home Depot. This is a name that came up with one of my premium members this week. I just want to highlight this is one that's pulled back to what you might generally consider one of those actionable buy points. March high was around 390, 395. We pulled all the way down to the 200-day moving average, languished there for a while, came back and retraced all the way back up, pushed above 400 to around 420, and now have come back. And now you're making a higher low at an ascending 50-day moving average at the previous resistance level, which now is potential support as the RSI is sitting right at 40. So what we used to call this was the fat pitch chart. Now that baseball season is done, congrats to the LA Dodgers on the win. Now that we're through baseball season, I'll finish with one baseball analogy. It's called the fat pitch chart. A fat pitch, if you know baseball, is one of those that the pitcher just hangs right over the plate. And regardless of what the count is or what the conditions are, you usually take a swing because it's just a high percentage hit, probably going to turn into something good. So you have to swing at a fat pitch. This is one of those charts, right? It was sort of a long-term uptrend, right? Sort of in a primary uptrend, but we're making a higher low and there's a potential to pull back to support. And you're betting on dip buyers, right? You're betting on people buying into this dip and pushing into the next swing higher. In this sort of environment, anytime you're buying something that's kind of coming down, you always want to have a good money management approach and make sure you minimize losses if you didn't catch a low and if do we just keep going down, which is a possibility, right? On any chart that's trending lower, the risk is that the downtrend continues. However, is it worth taking a shot at the next leg higher? That's what I would be thinking about if I'm considering a Home Depot right about now. Another question I got from one of my premium members, and again, my Market Misbehavior premium members are designed, if you like what we're doing on the show and you want a lot more sort of attention and focus on individual questions that are coming up, we have a active investor community, virtual courses, and a lot of custom reports or proprietary reports that I just provided my premium members. And one of the questions that I got earlier today was on CROX. And if you look at CROX, we talked about this on the show, and I got a good follow-up question just about where exactly to draw the neckline. And it's a fair point, right? Because if you look at CROX, I think the way that I probably draw the initial trend line is here, the one that I show in blue. But in red, you can actually see what Edwards and McGee, who wrote the book on chart patterns, what they would call as the neckline, it's really more based on the intraday highs and lows. That's what a general convention would be, is that you have to assume that the intraday highs and lows have value. And if you do that, then you really have to connect the April low to this low all the way down in August, which actually means we're still technically holding the neckline. I will tell you, in practice, the reason why I think of it more here is anytime I see one of these big kind of aberration days where we opened way down here, but by the close, we're kind of right back into that range. It's not like it didn't happen, but it's almost like there wasn't the follow through to really validate that that was a directional move. It sort of was more like a weird low that got bought very quickly. If you take the closing prices, that's what I tend to do is, all right, let me draw the neckline just using closing prices. That actually fits the date a lot better. And I think, okay, that's probably a better way to think about it. So the book would tell you use the intraday highs and lows, in which case this really isn't much of a head and shoulders pattern with that weird of a neckline. But I would say in practice, using the closing prices sometimes can give you a little more clear picture of the dynamics. And for me, chart patterns are all about telling the story of the dynamics. And I think that maybe better reflects the pattern we've seen on CROX, which means the gap lower and the continued deterioration really is a follow through from that breakdown of that close only neckline that I've drawn there. Just to finish off, I want to go through a couple of the Mag 7 names just very quickly. NVIDIA hurting along with the Magnificent Seven stocks, I would say, and certainly with semiconductors, right? The news from AMD is sort of ripple effect through all the semiconductor stocks here. And if you look, NVIDIA stalled out trying to get above that June high. And I think if we do get a big sell-off going into November, what I will do, and what I encourage you to do, is go back to October of 2024 and see what sort of warning signs you saw. Look for what warning signs you missed, right? And one of them, I'm always, as I see a potential move coming, I always try to take a snapshot mentally of what kind of things am I seeing right now that might end up being a really good example of why I should have paid more attention later. I think NVIDIA failing to break out could be an interesting story here. Think about Meta, failing to follow through after a breakout. A lot of these Magnificent Seven names have either stalled out at previous highs or have stalled out trying to break out, right? Meta did break out above 540, hit resistance at 600, and the month of October has been hitting that ceiling a number of times. So today is kind of just gapping off of that peak. Another one that I would say maybe Amazon, right? Amazon traded above this trendline resistance yesterday. Talk about, and we're looking at a test of 195, which is that September swing high. Instead of following through to the upside, it actually gapped back lower, and it's back below trendline resistance. So when you see a bunch of failed breakouts, it's not a guarantee that we're in a bearish phase, but I will tell you a sign of a healthy bull market is that you have good breakouts that continue. And I see that as sort of a broader measure of sentiment where investors are willing to pay more and they're willing to buy breakouts because they're optimistic that breakouts are going to continue. If you're more skeptical, if you're more nervous, if you're more risk averse, you see a breakout and you're like, get me out. This is great. I can cash out at 195. And that's what causes an Amazon to go down another 10 points by the next day's close. So I think some of the failed breakouts we're observing in some of those Magnificent Seven names could be a real cause for concern here. All right, let's continue on and maybe just finish the show taking a question or two if we could. I do have some questions about Apple, Amazon. Yeah, let's look at those. And I appreciate a number of you either commenting on or asking about aftermarket trading on some of these names. Let's look at Apple first. So we can see Apple down slightly. Yeah, it's down about 1 1/3%. Again, I would just caution you with after hours trading, especially around earnings, right? There's sort of usually that initial reaction right after the numbers come out, which is soon after the close. And then there's the earnings call, which could happen anytime between 4:30, 6 p.m. Eastern time, depending on when it's scheduled. And so the digestion of those numbers and really the Q&A and the comments are what can often, create some changes, particularly when we're, a lot of people focused on, forward-looking numbers, looking more at guidance going into 2025. That's become a real area of focus. I think understandably so, because there are a lot of, concerns about the sustainability of the rally that we've had, particularly with technology and an aggressive amount of spending into AI and infrastructure. What does that do for their revenue? And is it really turning into profits? Is it translating into growth for these for these technology companies. Apple, for what it's worth, down slightly. We'll call it 1.3%. After the close. Amazon is the other one, big one. And again, many reporting after the close today. Amazon actually gapping higher today, it looks like, after the close, which is good. Not much of a gap, though. We're currently trading right on 192.5 or so. So we're kind of right between yesterday's open and today's close, kind of right in the middle. Again, we'll see what happens through the remainder of the after-hours session. I'm super happy waiting for the next day to see what sort of follow through do we have. So one of the questions to sort of play on this discussion, Amazon is up after the call. Is it time to sell Mag 7 and improve cash? Or I guess, like, go to a cash position. Can you show the chart analysis of Palantir? All right, El Barca, let's take a look here. So for, in terms of the Magnificent Seven overall, is it time to sell the Magnificent Seven? I mean, generally speaking, I would say no. I mean, what you have to remember, all the charts that we showed, none of those are necessarily bad charts. They're just not as strong as they were a little bit ago, right? And I think that's important to remember. Charts that go down a little bit, I think are still okay. What you have to remember with any of those Magnificent Seven stocks is that you need to clearly define your exit strategy now, and that's what I think I would suggest for you is have a good exit strategy for some of these positions. I don't know if I'm seeing any deterioration in those that if I was long, I probably would be stopped out at this point, especially on the Mag 7 stocks necessarily. But I would have an answer now. Or what's that level? Where do you set an alert today so that if it happens tomorrow, you sell and you don't think about it? Remember, I mean, going back to the July peak, which is this chart here. So we're basically starting the clock at the July market peak. The S&P essentially went briefly above there, but as of today, it's almost back to the July breakout level. The Magnificent 7 ETF, the MAGS ETF, is actually down below its July high, as is the NASDAQ 100. The Qs are actually about 2.5% below the July peak all of a sudden. Gold still 11% above there. The equal-weighted S&P up about 3% relative to that peak. So the reason why I'm showing you this is that the Magnificent Seven are still not horrible, right? It's not that they're in primary downtrends, and a lot of them are, I would argue, still making higher highs and higher lows. The question is, do we break support? And those are the levels I would be highlighting, especially with some of these large names to confirm it. Someone asked, do I have a Discord server? I definitely don't, and I appreciate you asking about that. The only reason I'm answering this question that I don't have a Discord server, I'm not a fan of being in a chat room during the day. I like looking at charts and having conversations about the markets more than that. I also don't use WhatsApp for any sort of group, and that's been an issue that I've seen. I know people have used my name and picture without my approval to be starting WhatsApp groups. Those are scams that are not associated with. My stuff can all be found on my website at marketmisbehavior.com. So if you're confused as to whether something is actually coming from me, go there, and that will list out all the things that I am actively working on. I use WhatsApp for my personal connections with people outside the U.S., and that's about it. So that's not where I'm not looking to give you hot crypto tips in case that comes up. Those are the questions, folks. I want to thank you guys so much. I did have some questions I didn't get to, and I'll make sure that I pop them in the mailbag. Stay tuned for tomorrow's episode where we will do an all mailbag edition. I love answering some of the questions that I've received from all of you through the shows and through the course of this week. Also, as a reminder, our podcast is live and running. We had our 7th, maybe 8th episode. I'm losing track already. Ari Wald just had the conversation with him yesterday, and also posted my conversation earlier this week with Mike Turner, who is a mathematician and trend follower. Just gave a brief masterclass on trend following and systematic model-based approaches, which I thought was really thought-provoking. So I hope you enjoy those recent episodes. Lots more to come with hopefully Tom McClellan. I'll record soon. Adrian Day, actually, I interviewed him, and I'll post that very soon. And if there are others that I can interview as part of my efforts to bring some insights and awareness to all of you, let me know. Drop a comment wherever you're watching this, and give me some ideas. I'm happy to pursue anyone that you suggest. For Market Misbehavior, I'm Dave Keller. Remember, it's always a good time to own good charts. Have a great night. Happy Halloween, everybody.